Hi everyone, welcome back. Now in this lecture, we're going to understand the meaning of bond immunization. Let us say you have got $1,000 with you and you are ready to invest that money for a period of 2 years, and at the end of second year you want a realized return of 8% per annum. All right, so you've got $1,000 with you for a period of 2 years. You're willing to actually you're willing to invest it for a period of 2 years, and you want a realized return of 8% per annum. Now, if you earn anything less than 8%, then there is a risk that you will actually not be able to meet, let us say, your daughter's education. All right, let us say you need to pay for your daughter's education after a period of 2 years, and for that, you're investing $1,000 today. And if you do not earn 8%, then the risk is that you are not able to meet your daughter's education. All right, you're not able to meet one of your liabilities. All right, so you have got a liability at the end of second year for which you want to invest money today. And if you do not earn the desired rate of return, then you are actually going to fall short. Your liability will be an X amount. You are not going to have enough funds to meet your liability. Now you think you're actually a finance expert, you have all the knowledge of SFM, and therefore you go to the market and you are trying to actually find a bond whose YTM is 8%. All right, you think, oh, I know the concepts of yield to maturity, and therefore you are trying to find a bond whose YTM is 8%. And coincidentally, you have found a bond whose face value is $1,000, whose maturity is 2 years, and whose coupon is 8%, and whose YTM also is 8%. Although I've not mentioned it over here, whose YTM is also 8%. All right. Remember, coupon has got nothing to do with your required rate of return. Always it is the YTM which should match with your required rate of return. All right. Coupon is what the company is giving you, but ultimately what you earn, all right, your ultimately yield is actually the YTM. All right, because the market price can be greater than or less than $1,000, which will be resulting in a higher or lower YTM. If your market price is greater than or lower than your face value, then your YTM can be greater than or lower than your coupon rate. All right. Now I'm also giving you, I will edit this PDF. Let us say your YTM is also 8%. Let us say your YTM for this bond is also 8%. Guess what the market value would be? I have not given you the market value. I've given you the face value, the maturity of 2 years, and the coupon rate is 8%. And I'm also telling you that the YTM is 8%. Take a minute, pause this video, and guess what the market value of this bond will actually be. One, you can actually calculate the intrinsic value of the bond by drawing that table: years, this cash flow, present value factor, and discounted cash flow. But instead of drawing the table, if I ask you directly a question of what will be the intrinsic value of the bond, what will your answer be? Take a minute, pause this video, and think through. The market value is obviously going to be equal to the face value. Reason being, I have told you that the YTM and coupon rate are 8%. Both of them are 8%. When both of them are 8%, your market value and face value will actually be equal. Just a quick recap. If your YTM is greater than 8%, if your yield to maturity is greater than 8%, then the market value will be less than the face value. Why will it be less than the face value? Because you're earning a capital gain. You're earning a capital gain which is resulting in a higher return to you. I, as a company, am providing you 8%, but you're earning 9% YTM on the bond. Reason being, the price of my bond right now in the market is less than 1,000, which is giving you an additional capital gain. Vice versa for a capital loss. All right. If the YTM is lower than the coupon rate, then the bond is trading at a premium. YTM less than coupon rate, bond is trading at a premium. All right. That was just a quick recap. All right. So since you have now found a bond, you have decided to invest this $1,000 in that particular bond, and you are thinking that you would actually earn a realized return of 8%. In one of the lectures, I had discussed that there is a risk with this. What is the risk? Reinvestment risk. You will actually earn a return of 8%, only if you're able to actually reinvest your intermittent cash flows, only if you're able to reinvest the intermittent cash flows at 8% once again. All right. By buying the bond today, are you actually in a risk free position? The answer is no, because your actual realized return will be equal to 8% only if you're able to if you're able to reinvest the intermittent cash flow again at 8%. What is the intermittent cash flow over here? The intermittent cash flow is the coupon of year one. All right. Since the bond is of 2 years, you have year one coupon of $80. All right. And for you to earn that YTM, for you to actually realize 8%, you need to reinvest the $80 at 8% at the end of year one. At the end of year one, you're going to receive $80 and you have to reinvest this $80 for 1 year. All right. You will reinvest it for 1 year. You should be able to reinvest it at 8%. And only if you do that, your actual realized return, all right, your realized return will be equal to YTM of 8%. That is the risk that you're carrying. When you invest in this bond, you are supposed to be aware that there is a risk that you may not be able to reinvest it at 8%. All right. So if the market rates after 1 year fall, let us say the market rates after 1 year fall by 1%, and if the rate of return is only 7% after 1 year, then you are going to actually invest your $80 at 7%, and because of that, your realized return at the end of 2 years will not be equal to 8% per annum. And if it is not equal to 8% per annum, are you okay with it? The answer is no, because you have a liability to meet. You have to actually meet your daughter's education expense, because of which you will actually fall short, and therefore you're unable to meet your liability. And this is a massive risk in financial planning. You do not have funds to meet your planned liabilities. All right. So that this reinvestment risk is causing a situation where you do not have funds to meet your planned liability. Similarly, if the market rates after 1 year, let us say they increase to 10 percentage, all right. If the market rates increase to 10 percentage, then you're able to invest this excess $80, and not excess $80, this coupon of $80, you're able to invest it in the market at 10 percentage. You're able to invest this in the market at 10 percentage. And if you invest at 10 percentage, your actual return, your actual realized return will be greater than 8% per annum. All right. Your actual realized return will be greater than 8% per annum. All right. Over here, obviously, you're ending up in a surplus situation, which means the amount of funds that you have is greater than your planned liability. All right. So it's greater than the planned liability. So in this situation, you might be happy. All right. But are you actually willing to take the risk? All right. The question is, since you have a hard liability to meet, you might be okay in a situation where you have surplus funds, but you probably do not want a situation where you have a fund deficit. All right. You do not want a situation where you have a fund deficit. All right. Since your objective is to meet a hard liability, you probably cannot risk taking the fluctuations. Yes, there is a chance of gain and there is a chance of loss, but the pain that is going to be caused to you because of the loss is going to be more than the happiness on account of the gain. I'm repeating myself. Since this is a hard liability, the pain on account of deficit is going to be greater than the happiness on account of the surplus. All right. You cannot take the risk of this fluctuation. And obviously, a common sense thing is reinvestment risk is going to be higher in case of a long term bond rather than in case of short term bonds. Reason being, let us say you have a 10-year bond. You have to reinvest 9 years of cash flows. You're going to receive coupon of first year, second year, third year, and so on. So there is a higher risk in case of a long term bond, because you have to reinvest the first year cash flow, reinvest the second year cash flow, and who knows whether you will actually be able to reinvest all those cash flows at the same 8% rate. Whereas in case of 3-year bond, at least since the duration is shorter, there you at least have some amount of hope that you probably might reinvest it at 8%. Whereas you cannot have that hope in case of a 10-year bond, because the market rates might keep changing. Who knows if you're not able to reinvest it at 8%. All right, so the reinvestment risk is going to be higher for longer term bonds because you have many years of cash flows to actually reinvest. Now, how do we solve this worry? How do we solve this worry? You actually have a worry that you might not be able to meet your daughter's education expense. How do we solve this worry? What you can do is do not invest in a bond whose maturity is 2 years. What we did in the first case is we have invested in a bond whose maturity is actually 2 years. Instead, invest in a longer term bond whose duration is actually 2 years. All right, do not invest in a bond whose maturity is 2 years, but invest in a bond whose duration is 2 years. If the duration is 2 years, then it means the maturity is going to be slightly higher. It will say probably be 2.5 or 3 years. All right, hypothetically, let us say the maturity is 3 years. Let's not bother about the maturity. Let us invest in a bond whose duration is 2 years instead of investing in a bond whose maturity is actually 2 years. Now you might start thinking, what is the benefit that I've gained by doing this? In a bond that had a maturity of 2 years, you were actually receiving maturity value from the company of $1,000 at the end of year two. All right, in a bond whose maturity was 2 years, you had year one cash flow of $80, year two cash flow coupon of $80, and maturity of $1,000. All right, so when you invested in a bond whose maturity was 2 years, you received $1,000 of maturity value from the company at the end of year two. All right, you receive $1,000 at the end of year two from the company. If the bond has a maturity of 3 years, is the company going to give you $1,000 at the end of year two, or is it going to give you at the end of year three? The company will actually give you $1,000 at the end of year three. The company does not care when you have to meet your daughter's education. The company has got a contractual note where it will give you $1,000 at the end of year three only. It was you by choice who actually purchased this 3-year bond whose duration I agree was 2 years, all right, but the company is still not going to give you $1,000 at the end of year two. The company will actually give you $1,000 at the end of year three only. So, will you actually wait for 3 years? The answer is no, because you have a liability to meet at the end of year two. So, which means you now have to go and sell this bond in the market, in the secondary market, in the end of year two. If you were buying a bond whose maturity was 2 years, the company was giving you a maturity value of $1,000. What I did was I bought a bond whose maturity is actually 3 years. So therefore, the company will not give me any face value or maturity value at the end of year two. I will actually have to sell this bond in the market at the end of year two, which means for this particular bond, year one end, the company will give me $80. Year two end, the company will give me $80. Year two end, the company will not give me $1,000. I have to actually sell this bond in the market and generate a cash flow from the sale. All right. If I sell the bond, I will receive cash. All right. So now I have now got that responsibility on my head to actually sell this bond at the end of year two. All right, now if I actually have that responsibility to sell this bond at the end of year two, I am actually assuming one more risk, which is price risk. What is price risk? When I go to the market and when I decide to sell the bond, who knows what the price of the bond is going to be? The price of the bond is going to fluctuate, right? The price of the bond is a function of interest rates. Price of a bond is a function of the market interest rates, right? So the market interest rates, if they change, my price of the bond will also change. Whereas in the first example, when I bought a bond whose maturity was 2 years, I knew that whatever the interest rate in the market, I would receive $1,000 at the end of year two. But in case of this bond, I am now selling the bond in the market. Therefore, I do not have a certain $1,000 value, but I have again an uncertain value. The price might be high, the price might be low. I do not know what the price is. All right. So I'm now taking another risk called as price risk. All right. And this price risk is actually influenced by the market interest rates. All right. If it's influenced by the market interest rates, because if the market market interest rates go up, the price at which I'm able to sell the bond in the market will actually be less. If the market interest rates fall, the price at which I'm able to sell the bond in the market will be high. All right. Market rates low, the price will be high. All right. So this is called as price risk, which is the uncertainty. Earlier, I had a certainty of $1,000. Now I have got uncertainty. I do not know at what price I will be able to sell the bond in the market at the end of year two. You must be thinking, what a stupid fellow I am. Earlier, I was already suffering from one risk, which was the reinvestment risk, which is I do not know at what rate I will be able to invest $80. As if that risk was not sufficient, I assumed another risk, which is price risk, which means I do not know at what price I will sell in the market at the end of year two. All right. Why did I end up in this situation? Because I invested in a bond whose maturity was more than 2 years, but whose duration was actually 2 years. All right. So you might be actually thinking of me as a stupid fellow, which is actually right from your point of view. All right. Before I continue the further story, let's actually quickly skim through the notes. So the bond has maturity of 3 years, but I need the money at the end of year two. Therefore, what I'm going to do is I will actually go to the market and I will sell the bond at the end of year two. The company will not be giving me $1,000. In case of the first scenario, the maturity was fixed at $1,000, whereas over here I have a price risk, which is I do not know what price I'm going to receive at the end of year two. That is uncertain. All right. So price risk is the risk that I do not know. It is uncertain at what price I will actually sell in the market. Earlier, I had only reinvestment risk. Now I also have got price risk. All right. When I invested in a bond whose maturity was 2 years, when I invested in a bond whose maturity was 2 years, I only had reinvestment risk. Now, when I invested in a bond whose duration is 2 years, I've got reinvestment risk and I also have got price risk. I've got price risk. Now, if you carefully think of it, what is the influencer for reinvestment risk? The influencer for reinvestment risk is I do not know what rate will be what will be the interest rate after year one. All right, I will receive $80 at the end of year one. I do not know what will the interest rate be at the end of year one. That is called as reinvestment risk. What is price risk? Price risk is I do not know at what price I will be able to sell. The one main factor which influences price is nothing but interest rate again. Reinvestment risk is also influenced by interest rate. Price risk is also influenced by interest rate. Price risk is I do not know at what price I will be able to sell in the market at the end of year two. Price is influenced by interest rate. All right. So price risk also is trying to say, I do not know what the interest rates will be at the end of year two. Reinvestment risk was saying, I do not know what will be the interest rates in the market at the end of year one. Price risk is saying, I do not know what will the interest rates be at the end of year two, because I want to sell my bond at the end of year two. Price at the end of year two is influenced by the interest rate at the end of year two. All right. Reinvestment is basically at what rate will I reinvest. So both of them are saying reinvestment risk and price risk. Both of them are saying, I do not know what will the interest rates be in future. I do not know what will the interest rates be in future. All right. Before I go ahead with with further discussion, I will actually make a statement. Both reinvestment risk and price risk are actually are talking about uncertainty of future interest rates. All right, but they are going to be negatively correlated, which means reinvestment risk and price risk are going to be negatively correlated with each other in such a way that they will nullify each other and you will actually earn your desired rate of return of 8%. When you are investing in a bond whose duration is 2 years, you are assuming two types of risks, price risk and reinvestment risk. But these two risks are not additive in nature. They are not additive in nature. They are actually of the opposite direction, and in such a way that they will actually cancel out each other. They are going to cancel out each other and ensure that you earn a return of 8%. In case of a bond whose maturity was 2 years, you only had one risk, which was reinvestment risk. You did not have price risk at all. All right. Whereas in case of a bond whose duration is 2 years, you've got two types of risks, price risk and reinvestment risk, but they are not additive in nature. They're not multiplying with each other. In fact, they are of the opposite direction, and they are canceling out each other, and in such a way that the actual risk is going to get nullified and you will earn your desired rate of 8%. Now let's see how this is going to actually happen. Let us say after you buy this bond whose duration is 2 years, the interest rates in the market are actually falling. All right. The interest rates in the market are falling from 8% to say 7%. Now, when the interest rates in the market fall from 8 to 7, you are going to reinvest your $80 not at 8%, but you're going to be able to reinvest your $80 of year one coupon only at 7%. Therefore, you are at a loss over here. You are at a loss over here because the general market interest rates have fallen and you are able to reinvest your $80 at a lower rate of 7%. All right. So that is a loss that you're taking. But do you remember that when interest rates fall, the price actually goes up? When interest rates in the market fall, the price actually goes up. All right. So what is happening is your price, because you have to sell the bond at the end of year two, your price is now on the higher side. Interest rates have fallen from 8% to 7%. Therefore, your price has actually increased. Your price is now increased. All right. Earlier, if you remember our example, the market value also was $1,000, but now your market value is no longer $1,000. That is going to be greater than $1,000. All right. Earlier, we said YTM 8%, coupon 8%, and market value $1,000. Now, since the interest rates has fallen to 7%, YTM has actually fallen to 7%. Therefore, your price is actually going up. All right. So you made a loss in reinvestment, but you actually made a gain on selling the asset. On selling of the bond at the end of year two, you are making a gain. This gain you would not have made if you invested in a bond whose maturity was 2 years. Why would you not make this gain? Because the maturity value is fixed at $1,000. You're not going to receive more or less. You're going to receive exactly $1,000. But by investing in a bond whose duration was 2 years, you have actually gained this excess amount. All right. The required rate of return in the market is falling from 8 to 7. Therefore, your price is rising and you have now actually enjoyed this gain. All right. So you are actually reinvesting $80 at a lower rate, but upon a fall in interest rates, there's going to be an increase in the bond's price compared to its current value. Current market value was $1,000. There's going to be an increase in the market rates, and therefore we are benefiting on account of the price rise. You have made a loss on account of reinvestment, but you're benefiting on account of the price rise in such a way that these are actually canceling out each other. And this exact cancellation of each other will only happen if you invest in a bond whose duration is 2 years. If you invest in a bond whose maturity is 2 years, then this cancellation is not going to happen. But if you invest in a bond whose duration is 2 years, you're actually going to have a realized return of 8% in all scenarios. Whether the market rate falls or whether the market rate rises, you will definitely have a realized return of 8% per annum. All right. Let us actually see what will happen when the market interest rates increase. All right. Let us see what will happen when the market interest rates actually increase. When the market interest rates actually increase, you will actually have a reinvestment gain. All right. Let us say if it increases from 8 to 10%, you will actually have a gain because the $80 you're actually reinvesting at a higher rate. You're actually having a gain. All right. But when the market interest rates rise at the end of year two, the price will actually fall. All right. When the market interest rates rise, the price at the end of year two will actually fall, which means you're going to sell your investment at a lower value. The current market value was $1,000. You are actually going to sell it at something less than $1,000 because of the fall in price. All right. So you had a gain in reinvestment, but you had a loss on sale of the bond. But these two, gain and loss, they will nullify each other, and you will continue to actually have your YTM, or realized return, will exactly be equal to 8%. Your realized return will be exactly equal to 8%. You had a gain on reinvestment, you have a loss on sale, they cancel out each other, and your realized return will be exactly equal to 8%. Let us quickly summarize what we discussed again. If you are investing in a bond whose maturity is 2 years, you are affected by reinvestment risk. That through that reinvestment risk, you might have surplus or you may have deficit. All right. Surplus is where your interest rates in the market rise, and therefore you're able to reinvest that $80 at a higher rate. Deficit is where you're actually in market interest rates fall, and therefore you're able to reinvest at only 7%. All right. So you might end up in a situation of either deficit or surplus. All right. That is in case of investing in a bond whose maturity is 2 years. But instead, you are investing in a bond whose duration is 2 years. When the duration is 2 years, whether the market interest rates rise or whether the market interest rates fall, you will have a gain in reinvestment or a loss in reinvestment, which is exactly offsetting the gain or loss in the price risk. All right. If you have a gain in reinvestment, you'll have a loss in price. If you have a loss in reinvestment, you will have a gain in price, in such a way that they are exactly going to nullify each other out, and you will end up with an actual realized return of 8%, which is what you desired. All right. When at the beginning you invested in this bond whose duration was 2 years, the bond's YTM was actually 8%. All right. And you will actually end up with an actual realized return of 8% if you follow this method. All right. You have to invest in a bond whose duration is 2 years and sell the bond after 2 years. And in such a way, you will actually have a realized return of 8%. And in this way, you're actually able to meet your predetermined liability. You had a planned liability to meet your daughter's education, and by investing in a bond whose duration is actually 2 years, whose duration matches with the duration of the liability, the duration of the bond was matching the duration of the liability, and in such a way that the price risk and reinvestment risk are offsetting each other, and your actual realized return will be equal to the YTM of 8%, and you are actually immunized. All right. Your bond is immunized from any changes in interest rates. Immunized basically means safeguarded. All right. Your bond or your portfolio is now safeguarded by any changes or any fluctuations in interest rates. All right. Your is immunized by any changes your portfolio is immunized by any changes in interest rates in the market, and you're able to meet your planned liabilities. Therefore, to immunize your portfolio, ensure that duration of asset is equal to duration of liabilities. Ensure that your duration of assets is always equal to duration of liabilities. All right. Although I've uttered the word duration of liabilities, I actually said I have a liability whose maturity is 2 years. All right. I earlier when I was telling you, I told you have to meet your daughter's expense at the end of second year. That was actually maturity of 2 years. But over there, that is more like a zero coupon bond. You do not have any cash flow. You do not have to meet any liability at the end of 1 year. The only liability is you have to meet at the end of second year. Therefore, duration of the liability is also equal to maturity of the liability. I'm repeating myself. I said you have to meet your daughter's education expense at the end of year two. That was actually maturity of 2 years. All right. In this case, maturity of liability is equal to duration of liability, because you do not have any other cash flow in between. All right. If you had a cash flow in between, then the duration of liability, if you had another cash obligation in between, if you have any other cash obligation in between, then the duration of liability will be different from the maturity of the liability. But in my example, maturity is equal to duration of the liability is equal to 2 years, and buy your assets in such a way that the duration of assets is also equal to 2 years. Buy your assets in such a way that the duration of the asset is also equal to 2 years, which matches with the duration of liability. And remember, let us say if your duration of liability is 5 years, do you have to buy a bond whose duration is exactly 5 years? The answer is no. You can also buy two bonds, one whose duration is say 2 years, another bond whose duration is say 7 years, but the weighted average duration of the portfolio is 5 years. What I'm trying to say is, when I say duration of asset, don't just keep thinking in your head that you need to find one bond whose duration is 5 years. No, buy one particular bond whose duration is 2 years or 3 years, buy another bond whose duration is 7 years, and ensure that the weights are in such a way, the amount that you're investing in bond A and bond B, they are in such a way that the weighted average duration, and remember that is the reason why I showed you how to calculate weighted average duration. The weighted average duration should actually be equal to 5 years, which is matching with the duration of your liability. All right. So do not think that you need to keep searching for one bond whose duration matches with the duration of liability. The duration of your portfolio should match with the duration of your liability. And therefore, this comes the third meaning or definition of duration. Duration is that period over which your price risk is exactly offset by your reinvestment risk. The first meaning of duration was that it is the average period over which your amount invested is returned back, similar to payback period. Average period over which your amount invested is returned back. Second meaning of duration, I said, is it is an input to calculate volatility. All right, you calculate Macaulay's duration to calculate volatility. All right, this is the third one. Duration is that period wherein your price risk is exactly offset by your reinvestment risk in such a way that you're immunized from any changes in interest rate. All right, that's it for this lecture. I hope you have understood. If you have not, please go back and listen to it once again. I'm sure you will understand. All right, thank you so much. Thank you. Bye bye.